Welcome friends, Q3 is over and PayPal was the best performing stock in the Nasdaq 100. So let's do a quick recap.
The analysts don't seem to love the stock right now. It's just the last couple of weeks. I've taken a look at a few reports. Mizuho yesterday, PayPal faces competitive pressure from A to Z, downgrade. Oppenheimer, PayPal, or persistent profitability pressure has them downgrading it. Morgan Stanley, slower than expected progress on strategic imperatives. BTIG, too much uncertainty puts us on the sidelines.
I love being an underdog. I will take all of that feedback and we'll shock the world.
Yeah, it's just the stupidest thing I've ever seen. It looks like market manipulation, but nobody wins. So why would you come out and say we're going to rock your world or whatever he said?
We'll shock the world.
And then the big innovation is we're not investing in this. We're still cost cutting, but look, we're going to do a faster checkout. That's like table stakes. You have to have a faster check. We all understand that. There's nothing here. They should. I don't know. I'm not impressed by so far. It's a new CEO. Give them the benefit of the doubt. They report on February 7th. Maybe they will rock our world then.
We'll shock the world.
This is not what's popping in the streets. Like we don't roll like this.
A few moments later.
I like, as you know, when the fundamental news lines up with what we're seeing in the technicals. And they have a new CEO, and the new CEO is making incremental moves to improve the fundamentals. We've seen that in the last couple of quarters. And now we're starting to see big partnerships. And I think that's why the stock has been breaking out.
We'll shock the world.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and stocks retreated Tuesday as growing tensions in the Middle East poured water on investor enthusiasm, especially coming off a strong quarter. And we really kicked October off in October fashion with a sell the news type of event. Middle East tensions are brewing, missiles were launched, retaliation ensues, technology sold off as a result, Microsoft, Apple, Nvidia, but all of semis, all of infrastructure tech, stuff like Amazon, Tesla were down on the day, banks as well, very red in certain sectors. And you look at aerospace and defense, very green, utilities, very green, energy, very green as well. And that tells you everything you need to know. There were a couple of outliers as well. Visa, MasterCard, they were up 0.9, 0.43% on the day. ADP, paychecks, as well as payroll providers did very well today. Google and Meta up 0.63 and 0.87%. And you can't really see it, but right here in basic materials, if you look at gold was very green as well, or gold miners in the corner right here. So very bullish for certain places. They did very well in light of a bit of the sell side we saw today. The S&P 500 was down just shy of 1%. The best performing sector, energy, that was very obvious to understand why. Utilities, comm services, and then industrials were virtually flat, mostly held together by the defense sector. So if you were in aerospace and defense, you did very well in industrials today. I think they were the best performing subsector in today's trade. The worst performing sector was technology. It's very weird how these short-term events have such a major pull on the market, but I guess, you're going to get out of highly valued stocks, move into inflation hedges and geopolitical tension hedges. And that is stuff like energy, utilities, stuff like industrials. We also saw real estate, financials, healthcare, and consumer discretionary down, 0.6, 0.5, 0.4% respectively. And it was large caps, mid caps, small caps. Selling was everywhere, particularly in large cap growth and small cap value. They were the worst performing factors here today. And the core and value segments sort of held the entire market together. They were actually reasonable today considering the bloodbath we saw in these sectors. Like for example, large cap value only down 0.14%, mid cap value down 0.36%. To me, this just looks like a typical normal day. This right here down 1.4% to me looks a bit like capitulation. And it all stemmed off the news we got from the Middle East. Israel threatens retaliation for missile attacks that Iran launched. The US called these attacks twice the scope scope of the April assault. Israeli military says the attack will have consequences. US Defense Department says the attack was much larger than Iran's first ever direct assault. So, there was missiles launched, and now there's going to be retaliation. And to be honest, the writing was somewhat on the wall. Geopolitical tension was the second biggest tail risk coming into the month of September, and it's something the market hadn't discounted into its price. And that's why geopolitical news really shocked the market today, especially in the tech space. And that's why we saw energy, gold miners, those names rally, technology, risk-sensitive assets sold off. But on top of all of that, we also got some very mediocre data that did affect market flows. Final manufacturing numbers came in slightly better than expected, but pretty much in line compared to the forecast. ISM manufacturing missed. The forecast was 47.5. We reported 47.2. Construction spending missed as well. That's actually a monthly decline. However, the silver lining was actually jobs openings, or JOLTS. They actually beat expectations. The actual reported figure was 8 million, 7.7 million came in, and that's 1.2 jobs per unemployed persons, or job openings per unemployed persons. Very robust when you look at that. And that's why we actually saw HCM and payroll providers do very, very well today. Paychecks also dropped their earnings. They reported a double beat. So the JOLTS numbers, along with Paychecks earnings, saw HCM providers like Paychecks up 4.87%. ADP was up about 1%. Paycom software outperformed the market, only down 0.16% in normal trading, up and going on a bit of a rally here in the after hours. So this was the place you really wanted to be in. And that's why when you have like a positive fundamental catalyst, you can look past all the news and the entire sector can rally as a result. But let's dive into the charts. In light of all of the data and news we got today, the VIX was near the 20 handle, up 15% today. Equities across the board declined. The S&P 500 was down 0.93%. The NASDAQ 100 down 1.5%. The IWM down 1.36%. So large caps, small caps all sold off. Mid caps too. The RSP was only down half a percentage point, the best performing out of all the equity indices. It's up here in the after hours. I'm not sure if that is a liquidity issue or if that is correct, but it doesn't look quite right when you see stuff like the IWM, the Qs, and the SPY down 0.1% here in the after hours. But if you are in the RSP, take those gains when they come, and you're looking at a day that's pretty much flat for the day in light of all of the volatility we saw. Assuming that the RSP is actually up 0.41% in the after hours, that would mean the RSP was down 0.13%. It seems like a very average day in heightened volatility. As a result of today's data, yields actually fell across the spectrum. Bonds gained, the dollar gained significantly as well, up 0.45%. Bitcoin down 4%, a bit of a dumpster fire. Gold, silver, and commodities were all up very, very strong. Gold and silver were up about 1% in that area, and then crude, the outperformer, gained 3.77%. So you can see that all of this trade was based on the data we got and the geopolitical news. There wasn't much in the way of fundamentals. It was sort of just news headlines, big macro movers, and then the market moving according to the technicals. And we did see the market bounce at very key levels. Look at the S&P 500. This is the gamma flip zone. This is where we found support at the 56.75. So the market pulled back all the way from the 57.50 area to the 56.75 at the gamma flip. Found support. That's a big wick right there. Still a red day nonetheless, which goes to show the volatility we saw today. However, we are still in positive gamma, and it looks like the market did go ahead and buy this dip. But it wasn't just the S&P 500. If we look at something like the NASDAQ 100, very similar situation. Bounced right off its gamma flip, came right off its core resistance. Very, very key levels. Like just to the point, guys, came right down into this gamma flip zone. And I actually favor upside here for the NASDAQ 100, especially if we find support like we have today, move higher, break these highs, and have the core resistance move up. That would be very constructive, because that would just be another higher low relative to this and this consolidation we saw right here. Put in this higher low, break these highs, very, very constructive. Then we can use that as support and move to all-time highs, maybe towards the back end of October. Very constructive price action, but that's assuming this holds. If this continues to move lower into negative gamma, we would then target the 19,000 area, and that is a very similar situation for the S&P 500. But at critical zone, we break below here, we would then target the put support, and things can get ugly in this October period, particularly in election years. Election years are not pretty for October. Looking at the RTY, we actually did break the gamma flip zone at the 2200 area. However, we closed pretty much at the gamma flip zone. So we're going to really have to see how the Russell 2000 reacts tomorrow. I think if we have early morning price discovery below the gamma flip, I think we could actually see some sell side to 2150, which means the places that you actually want to be right now positioned is large caps, mega caps, relatively speaking, to small caps. I do know that the Russell 2000 outperformed the Nasdaq 100, but the S&P 500 outperformed the RTY. So I think the place you want to be is definitely some large caps, large cap quality, especially in this highly geopolitical environment. And going into jobs data later this week, I think, large caps, quality, mid caps, that's where you want to be. I think cyclicals are going to get destroyed, especially if we start moving into negative gamma. The very first thing people are going to sell is small caps in an environment like this. And they're going to buy bonds, they're going to buy quality. They're also going to go to stuff like gold and the dollar. So there's plenty of ways where money can actually be diversified away from stuff like small caps. So in this week, guys, be careful of small caps. They can cause a little bit of volatility. However, as long as we hold this low right here in the IWM, I'm constructively bullish into the end of the year for small caps. But all in all, you want to be buyers of dips in this, but do be prepared that if we do fall into negative gamma in small caps and maybe even some of these larger names, things can get ugly, especially in this October month, which is highly volatile in an election year. And we also have the election coming up. All of this is sort of coming together with the NFP report, and that can cause a lot of volatility. But you will get my take here first every single morning, Monday to Friday after the close. So go ahead, subscribe so you don't miss a beat and you always catch the latest. Diving into sentiment, CNN's fear and greed index. And guys, we are in extreme greed, probably for the first time in 6 months, maybe since March, I would say the start of this year. We are in extreme greed, on the cusp of greed, extreme greed at 75. And things are getting a bit frothy, especially according to this indicator. This indicator is largely dependent on credit market technicals as well as market breadth. We do know that credit spreads are extremely tight, breadth is expanding, and therefore CNN's fear and greed index is telling us we are in extreme greed, but on the edge of greed and extreme greed, meaning we could probably push a little bit further before we do see a pullback, but things are getting frothy nonetheless. But can this sentiment be painful for investors into the end of the year? Goldman Sachs think yes. And Goldman Sachs see the 2024 year-end target at 5,600. The S&P currently trades at about the 5745. So they do see about 145, 150 points of downside into the end of the year. This would still represent about a 19% gain from the 1st of January to the end of the year. Let's say 5,600 is to materialize, but they don't see an end of year rally. They just see sideways price action into the end of the year. However, the fundamental picture unchanged. They see $241 in earnings per share for the S&P 500 at the end of the year. This is up from the 223 mark in 2023, and they see 2025 earnings at $256. So this probably means, yes, while they do see sideways action into the end of the year, they probably do see asymmetrical upside into 2025. Nonetheless, this doesn't mean much to us at all. We really have to look at earnings per share in the context of valuation. And right now, the S&P 500 or US stocks look very, very pricey at 22 times forward 12-month earnings. The entire world, this includes the US, is sitting at 18 times, and the all-country world index at 18 times. Still pricey considering that this is the median PE for the entire world. You're looking at about the 15, under the 15 range. So the US is really making the global market look relatively pricey. But when you exclude the US, the rest of the market actually looks very reasonably priced. Look at Japan trading at 14.6 times. Its current valuation is at its median and in the middle of its interquartile range. The same with Asia Pacific, excluding Japan, a little bit pricey relative to its history, but still very attractive. Same here with Europe trading at its median, as well as emerging markets trading a little bit pricier than usual, but still attractive nonetheless. And especially emerging markets, the growth profiles in stuff like India, very, very attractive, relatively speaking. Now let's pose a hypothetical. Let's say you don't want to own US stocks because they look pricey, and you don't want to own international shares because they're not US stocks. How exactly do you diversify? One place you can look at is gold. Generally speaking, when we move into a cutting cycle, gold does very, very well. Look here in the early 2000s, we went on an aggressive cutting cycle. Gold rallied 66% in just a couple of years. In 2008, we went on an aggressive cutting cycle. Gold rallied 189% in a 6-year period. And looking at 2020, most recently after the COVID situation, in just 3 years, gold rallied 50% after the Fed cut rates to 0. And this is where we are right now. We are currently at the start of a cutting cycle, and this probably means there is a lot more upside for gold, especially since most of the rally happens after the first Fed rate cut. So there's plenty of upside left for gold. And Goldman actually forecasts gold to be at $2,900 an ounce in early 2025. Gold is currently trading at about $2,650 at the moment, and they base their $2,900 assumption on gradually rising ETF inflows with Fed rate cuts, moderating but still significant central bank purchase outlook on the London OTC market, and our rule of thumb that 100 tons of physical demand lifts gold prices by about 2.4%. All of this in aggregate, they see a 2,900 price target probably in the first quarter 2025, and this represents about a 10% rally from where we are currently. So if you assume in the next 3 to 6 months you're looking at a 10% gain diversified away from equities and you're not holding cash in a cutting cycle, very, very attractive place to put part of your portfolio is in gold. And I actually allocated about 1% of my portfolio to gold currently, but you don't want to discount equities at all, because average returns for the S&P 500 since 1950 in the fourth quarter is very, very strong. We see 4.2% gains, the best performing quarter out of any quarter, as well as the highest hit rate, 79.5% probability of posting a quarterly gain. So guys, if you do want to diversify away from equities, buy gold. It is poised to go higher. It's got a lot of tailwinds behind it. However, you don't want to be underexposed to equities because we are in the fourth quarter, and the fourth quarter tends to be very, very strong for returns, especially after October into November and December. And diving into some macro analysis, this is global GDP forecasts. We have the US, the Euro area, mainland China, as well as the global market. Very interesting. You can see the US, we've actually seen a slight uptick here in GDP. The Euro area has been pretty much flat. However, in the last year, we've seen a significant decline in GDP revisions. China has been practically flat, slightly down, but I'd love to see what this is going to look like in a couple of months, especially with all the stimulus they're putting into the market. All in all, the global market's GDP is actually rising on the back of mostly the US and more recently the Euro area kind of trading flat to sideways. But the place you want to be right now is definitely in the US, because their economy is growing and they're not doing a whole bunch of stimulus like China is. Yes, there is a lot of free money with the rate cuts, but that should just support economic growth. And the reason why we've actually seen the US outperform the global market in terms of growth and economic expansion is because economic data in the last couple of months has been very, very solid. In fact, economic data here in July, August, September was in the dumps. We've actually seen a bottom put in, and we're near the zero line. This is the economic surprise index. Pretty much below this line, we're seeing softer revisions to data. Above the line, we're seeing stronger data, and we're nearly at the zero line. And we're probably going to cross the zero line into the November-December period. And when that happens, that's going to support the rally, because as we get rate cuts, we want to see stronger economic data, because that's the whole premise now. Good news is good news. It was good news is bad news to tame inflation. Now good news is good news, because we don't want the economy to soften much more than it is right now. Diving into earnings tomorrow, guys, we had a big day of earnings today. We had Paychex and Nike here before the close, and tomorrow we just have Levi's, and that's about it. That's pretty much Q2 earnings done and dusted. I think we have one more week, a couple of minor names next week, and then we go into bank earnings. JP Morgan, Citigroup, they all report week after next. Looking at data tomorrow on Wednesday, we have MBA mortgage applications. earnings and ADP employment. That's pretty much it. The expectation there is 123,000. That's the consensus, and we don't have consensus for mortgage applications. And then after tomorrow, the rest of the week gets really, really dicey with initial jobless claims, services PMI, and then the big one is the labor report, the non-farm payrolls, as well as private payrolls. We also get the unemployment rate, average hourly earnings, and average weekly hours. And the reason why this is so big is because S&P 500 futures have been extremely reactive to NFP prints in recent years than any other major economic data print, especially since 2018. Returns around data releases have been 0.3%, so this is to the upside or the downside, and it's been the biggest mover in the market compared to stuff like GDP, CPI, JOLTS, jobless claims, industrial production, retail sales. So a very, very volatile week starts pretty much from Wednesday when we get the ADP report onwards into the end of the week. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.